Good afternoon, everyone. I see that Zoom is letting everybody in right now, which means that we're starting with our today's exciting webinar, which you've everyone awaited for long. And once everybody is joined, we'll start with the session. All right, I see that we already have sufficient attendees here. Let's quietly start. Good afternoon, everyone, and thank you for joining us today. My name is Andrei Sribny, and I'm the CEO of AML Certification Centre, a global institution dedicated to fighting financial crime through the development of practical skills and knowledge. This session was created with the clear purpose to bring together experts from Kenya and Europe to discuss one of the most pressing issues in compliance today: how to strengthen our collective defenses against terrorist financing and financial crime. It is the first part of our broader initiative leading up to the AML and ESG executive training in Naivasha, taking place the 30th of October, where we'll be bringing together regulators, financial institutions, and European experts to strengthen compliance capacity across the region and share best practices. We organized today's discussion because Kenya's current FATF evaluation, or FATF evaluation, and the wider regional context demand not only just awareness, but joint action. Our focus today is on international collaboration, learning from global experience while addressing the realities of East Africa's financial system. Around the world, countries that successfully exited the FATF gray list did so through coordinated reforms and international collaboration, targeted training, and open partnerships between regulators and the private sector. That's exactly the spirit of today's webinar: to exchange insights, align priorities, and prepare together for the next phase of Kenya's compliance journey. So this conversation is not an isolated event. It's a stepping stone towards more interesting events like the first physical event we have in Naivasha, and towards a stronger and more connected regional compliance community. Having said that, I will gladly give a word to Robert Muoka. Please, Robert.
Thank you. Thank you for that introduction. I hope you can hear me and I'm audible. Good afternoon, everyone, and warm welcome to all our distinguished guests and panelists and participants joining us for this critical and timely webinar. As you've heard, my name is Robert Muoka, Senior Partner, TMM and Partners Advocate, and it is my distinct pleasure to serve as your moderator for this session. And as Andreas said, we're gathered here today to delve into a subject of immense national and regional significance, that is Kenya's and the FATF grey list, whereby we seek to address key compliance issues and terrorist financing. Kenya's recent inclusion on the FATF grey list is not just a headliner. It's a clarion call for all stakeholders, both in the public and private sectors, to enhance our framework, strengthen our collaborations, and deepen our understanding of the evolving landscape of financial crime. So, to unpack this complex topic, we're privileged to have with us a panel of exceptional thought leaders and practitioners, starting with Eric Theuri, who is the immediate former president of the Law Society of Kenya. His vast experience and leadership within the legal fraternity has provided valuable insights into the various systemic and strategic responses that are required. We also have Barbara, who sits with the Law Society of Kenya Nairobi branch, and she'll be representing the chair, and she'll bring a vital perspective on the legal and regulatory challenges and the crucial role that legal profession plays in upholding compliance standards. We also have Andrea, who's introduced himself, the CEO of the AML Certification Centre. And as you saw on the poster, we are joined by our secret international expert, who is Irgos, and happens to be the immediate former head of the Financial Intelligence Unit of Lithuania. So I think I can hand over back to you, Andre, to start the conversation. Thank you.
Thank you very much, Robert. Yes, Igris is a renowned international expert in the anti-financial crime space. He was helping numerous countries as he was a member, a representative of Lithuania in the Moneywall Committee, which is a regional financial action task force body. And he was personally evaluating some countries as well. So his vast experience is especially important in this international dialogue. So we'll be hearing his thoughts and his experiences firsthand from him. As you may know, or you may not know, because Kenya is a bit new market for us. So before we start with with the presentations and keynote speeches, let me briefly introduce who we are and what we do, especially for the new colleagues joining us today. AML Certification Centre is an internationally recognized and accredited Europe-based certification and training institution. We're building a global community of professionals in the anti-financial crime field as well. The trend we're responding to is clear. There is a growing shortage of well-trained AML specialists, while regulations are becoming stricter and the misconduct cases are on the rise. Many organizations are struggling to keep up, and that's where we come in. And our background is rooted in years, decades of experiences with the respected industry, leading experts practitioners, leading our course and expert-led live training programs development. And we use innovative practical methods and deliver training through a user-friendly platform. So we emphasize on practical skills development. And in short, we keep individuals and organizations with the knowledge and practical tools they need to stay ahead in the vast evolving compliance landscape. Thank you very much. And for today's agenda, what are we going to cover today? So you understand everything and the topics we'll cover. We'll start from the two opening keynotes on the current status of FATF evaluation in Kenya and why it's important, the FATF evaluation and compliance with FATF recommendations. We'll also switch to a more to a presentation about the understanding of what is FATF evaluation and what the compliance with FATF recommendations means, and what are the global lessons, how countries successfully exited the FATF gray list in the past. And then we'll switch to a more practical topic of terrorist financing risks. We'll review different terrorist financing typologies, what are the current terrorist groups, active terrorist groups in East Africa, and what methods they use to finance their activities. And then we'll come to an interactive panel discussion where we'll discuss different practical topics of how Kenya could exit the gray list, what is currently happening, and also Igris will share his practical experience. And the Q&A session for all, so stay tuned. Keep your questions, write your questions in the chat. We'll address them at the end of the event. Having said that, please let me, as I understood, we had some unexpected changes in the panelists. So Barbara, who's representing Eric Kiwuba, will be giving her keynote speech. Please.
All right. Good afternoon, good morning, good evening, according to our respective jurisdictions. Yes, you're right. My name is Barbara Maura. I am a council member of the Law Society of Kenya, Nairobi branch. I will be presenting our keynote speech on behalf of our chair, Mr. Eric Kivuvu. And so the speech is about discussion about the current status of our FTF status of Kenya, what are our major compliance gaps, what are achievements made this far, and what's the way forward. So as of October 2025, Kenya is still on the FATF's grey list of jurisdictions under increased monitoring for strategic deficiencies in combating money laundering and terrorist financing. This status was assigned in February of 2024 after a 10-year hiatus. The Kenya government has committed to an action plan to address the identified issues. Some of our major compliance gaps include: one, we have had insufficient prosecutions. Authorities have failed to demonstrate successful investigations and prosecutions of money laundering and terrorist finances offenses, despite us, the country, having a high risk profile. Second is that we have unregulated sectors. Key sectors is including the non-profit organizations, real estate, virtual assets, casinos, and certain designated non-financial businesses and professions remain inadequately regulated and supervised for money laundering and terrorist financing risks. Then third, we have weak beneficial ownership oversight. So despite some progress, we still have an opaque environment around beneficial ownership disclosures, which could allow politically exposed persons, PEPs, to launder proceeds from corruption. We also have inadequate enhanced due diligence procedures for PEP transactions, which are also a concern. We also thought we have low recovery of criminal proceeds. The recovery of proceeds from serious crimes like fraud and drug trafficking remain very low relative to the risk profile. And then lastly, we also have a limited understanding of risks. So this includes assessments showing gaps in understanding and mitigating terrorist financing risks, especially concerning the non-profit organization sector. However, we have made some positive strides. So some of our achievements this year include: one, that there is improved technical compliance. So according to the 2024 evaluation, Kenya was deemed compliant for 19 and largely compliant for 9 of the FATF's 40 recommendations, which showed a continuous improvement with regards to legislative framework. Second, we also have had updated national strategies, which Kenya has done so by having one, the amendment 2025, which came under amendment this year, improve scope of KYC, that is large financial transactions, and also entities that are under scrutiny. We've also had sector-specific regulations since we have new laws now, which regulate dealers in precious stones and metals, require them to report suspicious transactions to the Financial Reporting Centre. And lastly, we also have had enhanced capacity building. So the government has established new specialized divisions within the public prosecutor's office, with a fight corruption, organized crime, and terrorism financing.
All right, everyone. I apologize. Barbara is expecting some problems with her internet connection, but it's not a problem. I think we'll switch to the next keynote speech. Just to keep the flow and keep yourself engaged, and we'll return to her experience during our panel discussion. So I would kindly ask Eric Theuri to continue with the former president of the Law Society of Kenya. Please, Eric.
Thank you, Andre and Igoris, for putting together this very, very exciting event. I hope that the network will be kinder to me than it was to our
My
previous
apologies.
presenter, the lady from, and my leader at the Nairobi branch. But I can see she's back. Barbara?
I apologize. I don't know at what point I dropped off because I finished the speech and I handed it over back.
All right, that's fine.
So,
But I think you must have been at the conclusion because I
all
also
right.
can't
No,
quite.
okay.
Mm.
All right. So let me just take it from the road ahead, and then senior, you can also take over. So the road ahead is that despite the progress we've made in updating our legal framework, Kenya's path of the grey list still depends on moving from policy to effective implementation and enforcement, particularly against well-connected individuals. Kenya has a history of exiting the grey list as it had been removed in 2014 and therefore requires sustained political goodwill and adequate resources for regulatory bodies are crucial for long-term success. Thank you very much.
Thank you. Thank you very much, Barbara. It's very good that you finished your speech. All right, Eric, please.
Thank you, and thank you, Barbara. It's nice to see you after a long time. I was asked to speak about the Kenya grey listing, the FATF challenge, and the way forward. And I'll begin by taking us all back to February 2023, when it was announced that Kenya had been placed on the grey list. And for us, this was a moment that after several years of steady progress, the FATF, which is the global watchdog for anti-money laundering and terrorist financing, made a decisive move and placed Kenya on the grey list. And that single act, of course, sent a ripple effect through the banking sectors, the boardrooms, and the international partnerships that Kenya had cultivated. But I think it is also important that we discuss this and what it truly means, and so that we can understand where we need to go from here. So my discussion will seek to break down three critical points. That is what this status really signifies. The second will be the critical compliance gaps that we must close. And third, the progress that has been made, which should give us comfort that we should be able to succeed. So first of all, let's just understand that grey listing is not just a label, and it is also not a mark of failure. It is a formal statement that a country is committed to working with the FATF to address critical strategic deficiencies in its anti-money laundering and counter-terrorism financing regime. In Kenya, in short, it means that Kenya is now under increased monitoring. And so the immediate impact would be enhanced scrutiny. Every international transaction, every correspondent banking relationship now carries a higher compliance cost. It is a label that can deter investment and tarnish our reputation. But it is also a catalyst, a burning platform for decisive and necessary reforms. So the specific gaps that the FATF has identified are significant, but they are not insurmountable. And they fall into three key categories. Number one is risk-based supervision. Our regulators need to move from a rule-based to a true risk-based approach. This means not just ticking boxes, but proactively understanding and mitigating the unique money laundering and terrorism financing risk within our vibrant and also quite complex financial system, from our large banks to our to the rapidly growing appetite for fintechs and SACCOs. The second issue is financial intelligence. And so therefore, the Financial Reporting Center must be more proactive and strategic. We need to move from simply collecting suspicious transactions report to analyzing and using that data to launch impactful investigations and prosecution. The gap between reporting and successful conviction still remains far too wide, and I think we all know this, and it's been something that has been highlighted even by Barbara. Three is the question of tackling illicit flows. We must dramatically enhance our efforts to investigate and prosecute the full range of anti-money laundering activities, especially those linked to major crime. These include corruption, which siphons away public funds, and the complex financial networks that fuel terrorism and organized crime. We need to prove that crime doesn't pay by following the money trail and securing convictions for money laundering itself. Now, let us not for a moment forget that we have made some progress and there is opportunity for us to build on that. We have a strong legal framework. We have already an established financial reporting center, which we have seen a dramatic increase in the number of financial reporting reports being filed. This shows a growing awareness around and within our financial systems. And critically, we have demonstrated high political will. The creation of a multi-sector agency task force directly overseen by the president sends a powerful signal that Kenya is serious about addressing these issues. It is not just a regulatory problem, it is now a national priority. So where does all this leave us? Kenya is at a compliance crossroad. The gray list is not a life sentence. It is a strict rehabilitation program. Our exit strategy is clear, is defined, and is achievable. The path requires a unified effort. It requires our regulators to be empowered and to be agile. It requires our law enforcement to be financially literate and forensic. It requires every single one of us in the private sector to be vigilant gatekeepers, investing in compliance not as a cost, but as a cornerstone of a stable and prosperous economy. The achievements we have made so far prove that we have the capability. The gaps show us the way. Let us see this moment not as a setback, but as the final push to build a financial system that is not only robust and resilient, but also trusted across the globe. The world is watching. Let us show them what Kenya is made of. Thank you so much for giving me this opportunity to speak to you. Andre, over to you.
Thank you very much, Eric. I agree with you completely that let's show everyone that we can fight financial crime effectively and through effective measures, and most importantly, with skilled professionals and knowledge professionals. All right, let's now start with my first presentation Eric and Barbara. They have already covered the importance of the FATF gray list, but let's take a closer look what it actually means before we start with the practical part. So let's begin with an important perspective. FATF monitoring is often perceived as a penalty, but as Eric said, in the truth, it is a structured roadmap for reform. Every jurisdiction that has successfully exited the gray list has done so by treating this process as an opportunity to professionalize its systems, train its people, and rebuild confidence. And Kenya is now at that very point, as was said. The current evaluation offers a chance not only to strengthen legal and regulatory frameworks, but to elevate the competence and credibility of the entire compliance community, from financial institutions to law enforcement and supervisors. This is not a setback. it's a moment of alignment where Kenya can move from defensive compliance to leadership in global AML and CDF standards. And that journey begins with understanding how other countries have navigated this process successfully and what lessons we can apply here in Kenya. To move forward, we first need to understand what the FATF evaluation actually measures and what it does not. FATF looks at two dimensions: technical compliance, whether laws, regulations, and frameworks are in place, and effectiveness, whether those systems are working in practice. Altogether, that means 40 recommendations and 11 immediate outcomes that form the global benchmark for AML and CDF or CFT performance. When a country is placed under increased monitoring, often called the gray list, it does not mean blacklisting. It means that FATF has identified strategic deficiencies and that the country has formally committed to addressing them. It's guided process with an action plan, follow-up reports, and finally, re-evaluation and delisting once progress is demonstrated. The real goal is not punishment, it's progress. FATF's intention is to help countries strengthen their systems, close risk gaps, and align with global standards. And that's where our mindset matters most. Being grey-listed is not a label to fear, it's a call to improve. And for Kenya, this process is an opportunity, as for other countries, to refine coordination among regulators, modernize supervision, and professionalize the compliance function across sectors. Each step we take within this cycle from assessment to action moves the country closer to delisting and, more importantly, to sustainable credibility in the international financial system. When a country is placed under increased monitoring, the impact goes far beyond the compliance departments of banks. It reverberates through the entire economy. First, the economic impact: investors and correspondent banks see the gray list as a risk signal. That perception alone can reduce foreign investment, increase the cost of capital, for example, and raise transaction fees for cross-border transfers with other countries. For small and medium institutions, even simple international payments can become slower and more expensive. Second, the institutional impact: gray listing puts significant pressure on national institutions, especially regulators and supervisors. They must respond to new FATF recommendations, redesign risk assessment, and show evidence of effective enforcement. This can stretch human and technical capacity, but it also drives institutional reform. We have seen in countries like Mauritius and Botswana that this pressure often leads to modernized supervision frameworks and stronger public-private cooperation. And finally, the reputational impact: once a country is gray-listed, international banking partners tend to apply enhanced scrutiny or, in some cases, restrict correspondent relationships. For a regional financial hub like Kenya, that poses a real threat to its position as a gateway to East Africa. The key takeaway is that FATF evaluation is not just compliance checkboxes, it's about the country's economic credibility. And addressing these issues is therefore not only a matter of meeting international standards, it's a matter of protecting local reputation, investment climate, and long-term financial stability. And the numbers behind the FATF process tell a very clear story. According to the International Monetary Fund, countries placed on the FATF gray list experience, on average, a 7 to 8% decline in capital inflows relative to gross domestic product. There is a very significant contraction, especially for emerging economies that rely on external investment and remittances. To put it simply, when a country is under FATF monitoring, international investors and banks tend to reevaluate their exposure, and correspondent banks apply stricter due diligence, foreign lenders demand higher risk premiums, and the private investors often delay decisions until confidence is restored. This means that gray listing doesn't just affect compliance officers, it affects business owners, borrowers, exporters, and even the ordinary citizen, because the overall cost of doing business rises. One of the clearest lessons Kenya and other countries can draw comes from the European Union's recent reforms. The European Union realized that despite having robust AML directives, fragmentation among our member states was undermining effectiveness. Each country interpreted and implemented rules differently, which created uneven supervision and loopholes that criminals could exploit. Some of the European member states even got to the gray list, like Croatia and Bulgaria. This is something the European Union cannot afford. To address this, the European Union established the Anti-Money Laundering Authority, or AMLA, and alongside it, a single AML regulation and a dedicated crypto assessment framework, crypto assets framework under MiCA. This marked a fundamental shift from national silos to joint supervision and shared accountability. And these reforms have three main goals. First, to ensure consistent data sharing and unified enforcement across all EU jurisdictions and all regulators. Second, to integrate oversight across banking, fintech, and virtual asset service providers so that regulatory blind spots disappear. And third, to deliver a system that responds to financial crime risks faster and more coherently than any single national authority could do alone. The European experience highlights a powerful principle and a very important idea. Structural consistency is a prerequisite for effective compliance. So collaboration, whether between different member states, which is not so relevant for Kenya, collaboration between different institutions or different regulatory authority is of utmost importance in achieving full compliance. And for Kenya, this lesson is directly relevant. Fragmentation between institutions, whether between financial regulators, as I said, weakens the collective response. And building shared data systems, harmonized supervision, and clear interagency coordination is not just administrative reform, it's the foundation for credible performance in the FATF framework. And one of the most powerful lessons from the European Union's AML reforms is that education is measurable compliance. Across European member states, regulators and financial institutions have realized that laws and systems can only be as strong as the people implementing them. That's why the European Union has made CPD accredited training and certification a central part of its AML and CTF infrastructure, or assessment of the compliance professionals' competences. The focus isn't just on theoretical knowledge, it's on practical competence, training compliance officers, supervisors, and auditors to identify typologies, analyze suspicious patterns, and conduct meaningful on-site inspections. This professionalization, as to speak, has led to immeasurable improvements in the quality of suspicious transaction reports and overall supervisory effectiveness. What's even more important is how the European Union has embedded accountability through professional certification as well, which is not a mandatory part of the regulation, but which is very widespread within the European institutions. And certified specialists carry not only knowledge, but also responsibility. They become custodians of a culture of integrity. And for Kenya, this is a critical takeaway. As the FATF evaluation moves forward, the country will need not only regulatory alignment, but competent practitioners who can translate policy into action. And building a network of trained professionals and skilled professionals, both in the public and private sectors, will be essential to sustain progress after the listing as well. The second thing I also wanted to share with you is about the region I come from, the Baltic states, Estonia, Latvia, and Lithuania. from where we're bringing experts to the main event in Naivasha. When the Soviet Union collapsed, our countries were in chaos. There was banditism, racketeering, corruption, and even human trafficking. And with that came illegal money, of course. It was a complete disaster. And I believe Igoris can confirm it. But within 20 years, 20, 30 years, we achieved extraordinary success. Today, Estonia and Lithuania are among the countries with the lowest corruption and criminal rates in the world and the most robust anti-financial crime frameworks. And the people who built those systems, who turned complete disorder into a model of governance and transparency, are already here in the face of Igoris, and also will be joining you in Naivasha. That is what this journey is about, learning from those who have done it and working together to build a stronger, more resilient AML and CDF ecosystem for Kenya and the region. As we conclude with this part of FATF evaluation and its importance, it's important also to recognize that the path from gray listing to delisting is not theoretical. It's been done and done successfully right here in the African region. For example, Mauritius was placed on the FATF gray list in 2020 and delisted just 2 years later. And one of the fastest, it was one of the fastest turnarounds globally. How did they do it? By creating a national AML committee, aligning supervision across institutions, and investing heavily in the training of compliance professionals. They treated the FATF action plan as a national project, not just a regulatory task. Botswana and Ghana achieved the same success through strong interagency cooperation and targeted technical training. Both countries understood that no single institution could deliver compliance alone. It required collaboration between the financial intelligence units, regulators, law enforcement, and the private sector. When we look at these examples, 4 common factors stand out: a clear national roadmap with measurable milestones, skilled professionals capable of implementing reforms, and more importantly, to follow them, or it will only stay on paper. Political will that sustains the process at every level, and finally, international collaboration, ensuring transparency and credibility with global partners, and also sharing experiences. These countries proved that FATF delisting is not about avoiding scrutiny, it's about building resilience. And Kenya now has the same opportunity. With a united approach, strong leadership, and investment in human capital, delisting can be achieved not just as a technical success, but as a signal of national confidence. All right, let's switch to a more practical session on terrorist financing current risks. We'll start with global trends and typologies, and then narrow it down to the East African specifics. But before we start, please write in the chat, what do you think is the main difference between money laundering and terrorist financing? And I will review your responses after the presentation. So, terrorist financing today looks very different from what it did even 5 years ago. FATF's update of 2025 makes one thing clear. Terrorist financing has diversified. We no longer see a single funding model or a centralized structure. Instead, financing streams have become smaller, faster, and more decentralized, reflecting the way modern extremist groups operate. Let's look at 4 main trends driving this shift. First, diversification. Groups are no longer relying only on donations or state sponsors. They're blending sources from trade, smuggling, and extortion to legitimate-looking businesses and informal community contributions. Second, the continued misuse of nonprofit organizations. Nonprofit organizations, especially those working in humanitarian contexts, remain vulnerable because of the regular small value payments they process. Many are completely legitimate, but a few are exploited to disguise regular cash flows to affiliates or conflict zones. Third, technology. The rise of crypto assets and social media crowdfunding has made it easier to raise and transfer funds quickly, often across borders, with limited traceability. And FATF's report notes that virtual assets are now mainstream tools in the terrorist financing landscape. And finally, conflict-driven economies in regions such as the Sahel, the Horn of Africa, and parts of the Middle East, armed groups have embedded themselves in local trade networks, taxing goods, controlling checkpoints, and exploiting natural resources. All of this means terrorist financing is evolving far faster than traditional supervision frameworks. And for East Africa, where cross-border trade, cash economies, and digital payments intersect, this presents a unique challenge: how to balance financial inclusion with robust control. And understanding these shifts is the first step towards building defenses that are relevant, practical, and effective in the current environment. To understand terrorist financing risks and typologies terrorists use, or methods of terrorist financing terrorists use, we first need to understand where these networks operate and how their geography shapes the way they raise and move money. What you see on this map is a simplified view of the world's most active terrorist and extremist organizations. While their ideologies differ, their financing methods often overlap. At the global level, we have the two central nodes, Al-Qaeda and the Islamic State. They no longer function as traditional hierarchies. Instead, they operate as brand franchises, providing ideology, communication tools, and logistical support to regional affiliates. These networks influence both fundraising and operational strategy across other continents. In West and Central Africa, groups such as JNIM or ISGS and Boko Haram as well control territory, impose local taxes, and exploit trade routes, particularly in gold, livestock, and fuel. Their funding is primarily domestic, but the proceeds are laundered through regional informal transfer systems and commodity exchanges. In North Africa, Akim and Ansardine rely on smuggling networks that connect the Sahel to Libya and Algeria, moving not just cash, but also weapons, people, and illicit goods. Across the Middle East, the Islamic State, Al-Qaeda, and Houthi networks dominate the terrorist financing landscape, drawing on donations, extortion, and trade in conflict-affected commodities. In South and Central Asia, we see groups like Lashkar-e-Taiba, Jaish-e-Mohammed, and Taliban or ISKP, which maintain complex cross-border funding channels and use both formal and informal financial systems. And finally, in East Africa, groups such as Al-Shabaab and Islamic State affiliates rely on local taxation, smuggling, and cross-border remittances. Their funding networks are small, consistent, and resilient, making them particularly difficult to disrupt. And the global picture is therefore highly decentralized, as you can see. Each region has its own ecosystem of threats, but collectively they form an interconnected network, one that adapts rapidly to enforcement, technology, and opportunity as well. In the next slides, we'll examine how these regional dynamics translate into specific financing typologies, particularly in East Africa. But before, let's take a look at the global terrorist financing typologies and what's changed. When we look at terrorist financing globally, the key question isn't who funds terrorism, it's how they do it. And FATF reports and local intelligence reports identify 6 dominant typologies that continue to evolve across regions. Each one demonstrates how legitimate financing mechanisms can be subtly misused to sustain illicit networks. And first, as always, trade-based terrorist financing. This remains one of the most resilient typologies. Terrorist groups and their facilitators manipulate import and export invoices, use shell companies, and exploit under or over invoicing to move value across borders under the cover of trade. Second, crowdfunding platforms. These are increasingly used to disguise fundraising campaigns as humanitarian or social causes, and the amounts collected are often small but regular, making them difficult to detect without contextual analysis. Third, crypto assets. The misuse of virtual assets has entered the mainstream of terrorist financing. They use mixes, privacy coins, and decentralized finance platforms. Fourth, charities and non-profit organizations, as already told, in some cases, legitimate donations are diverted for illicit use. Fifth, cash and Havela networks, classic. In regions with limited financial inclusion, informal value transfer systems remain dominant. And sixth, commodities. Gold, charcoal, sugar, and oil remain common trade-based assets used to generate or conceal funds, and which are very difficult to trace. And each of these typologies underscores a common theme. Terrorist financing exploits the gray zones of the legitimate economy. And one of the fastest growing and most concerning trends in terrorist financing is the use of virtual assets, cryptocurrencies, and decentralized finance platforms. FATF analysis shows that while large-scale terrorist operations still rely primarily on cash and informal systems, virtual assets have become the preferred tool for microfinancing, propaganda, and recruitment activities. These aren't million-dollar transfers. We're talking about small, frequent transactions, often below reporting thresholds, used to sustain online networks, purchase digital services, or fund travel and equipment. Groups such as ISIL-K have been documented using Monero, a privacy coin designed to obscure transaction details, and encrypted channels like Telegram to solicit and move donations globally. Another growing pattern involves the use of social media fundraising campaigns that link to digital wallets or QR codes, and these campaigns frequently appear humanitarian. For example, support families in conflict zones. But a portion of these funds is diverted to extremist causes. And one of the most striking insights from the FATF report as well is how terrorist financing risks are now shifting geographically, particularly towards regions that combine high financial innovation with weaker regulatory enforcement. And Sub-Saharan Africa and Central Asia have both been identified as emerging crypto risk hubs in many of these jurisdictions. Rapid adoption of crypto assets or virtual assets has outpaced the establishment of comprehensive regulatory frameworks. And this creates gaps, not necessarily because of intent, but because of limited supervisory capacity and inconsistent licensing of virtual asset service providers. That's why licensing of VASPs is very important. And the reports show that in the Sahel region, terrorist groups are increasingly receiving support through third-party crypto platforms. And these aren't exchanges based locally. They are often hosted in foreign jurisdictions with loose know your customer controls, allowing donations to be routed to local wallets that are later cashed out. Let's see at one of the schemes. This is Trade and Natural Resources scheme, which remain one of the most resilient and profitable funding streams for terrorist groups, particularly in fragile or resource-rich regions. So this diagram illustrates how a seemingly legitimate commercial process can be transformed into sophisticated terrorist financing frameworks. It begins on the left with extraction and initial sales. So terrorist groups infiltrate areas rich in gold, timber, oil, and receive those resources. These goods are then sold to local brokers who provide them the layer of obfuscation. Here, multiple intermediaries and commodity exchanges also come into play. Transactions are structured through a series of resales, markups, invoice manipulation, etc. And the proceeds are then channeled through a legitimate trade system, including formal commodity exchanges or regional trade hubs, which leading us to the final stage, integration, completes the laundering cycle and the obfuscation cycle, because in terrorist financing, comparing with money laundering, it's important to obfuscate not the origin of funds, the question I asked previously, but to obfuscate the destination of these funds. Here is also an interesting case. It's from the personal experience of Igoris. So I would gladly give him a word to speak about this case, which he investigated personally. Please, Igoris, take your word.
Hello, everybody. Thank you very much, Andrei, for excellent presentation. Thank you very much, colleagues, for invitation. Eric, Robert, I'm very happy to be here with you. And of course, I first time to see that somewhere I was presented in international forums as secret agent. Okay, it's nice, but definitely talking about my career, I was not involved in such very secret operations, definitely. But some long time I worked in Lithuania, where I started, we established financial intelligence unit already in 98. It means how many years ago? And 27 years ago, and from the first step of our financial intelligence, I was involved in activity in the senior management positions. But today we have a discussion about, first of all, about terrorist financing, and what I see from chat. I fully agree with colleagues that here financial terrorist financing phenomena absolutely different as phenomena of money laundering. And key risk here and key problems here is that terrorists or terrorist finance terrorist groups and terrorists could be first of all funded or supported by using legal assets, absolutely legal assets. It's first bad news. And second bad news, talking about current changes of this so-called market. I could also to show you a very interesting difference between situations fixed by FATF, definitely. If you remember some already quite long time ago, it was so special, not only 40 recommendations of FATF, but 49 recommendations. I mean 40 recommendations and plus 9 special recommendations focus on terrorist financing. And one of these recommendations, which I really like it was recommendation 9, cash couriers. And very long time, it was main focus of law enforcement was really paid to cash movement, cross-border cash movement of probably one of the key tool and for terrorists, supporting terrorist activity in different countries. But now definitely after some period of time, now we have this recommendation 32 concerning cash couriers, but probably now already not so many experts to talk that cash couriers is our key trees here, because we more and more talking about non-cash operations, which Andrei presented here before. And it is also one of the key problem here that terrorists could be funded not by big or serious significant amount of assets, what we usually see in money laundering scheme, but could be funded differently by very, very small amounts. And here, for example, now what we would like to present is a practical experience. It's example for practical experience of investigation of terrorist networks. Unfortunately, but this terrorist network, which we would like to present here, was not prevented, and unfortunately was involved in 2 very serious terrorist attacks in 2015 in Paris, in 2016 in Belgium, where unfortunately many people were killed, just peaceful people in the street were killed during this attack. And in Belgium, 2016, this terrorist attack was committed during just in the area very close to European Commission buildings. And but what happened here? Just I don't like to spend a lot of attention to the end of this story. It's mean a successful terrorist attack, unfortunately. But on beginning of this story, what financial investigation presented us, financial investigation conducted after this terrorist attack. And here we see that one of the source of assets was so-called microcredits or loans received from microcredit companies, when it was identified that it's quite easy, unfortunately, quite easy for criminals, not only for terrorists, but for criminals, to get small amount of money in different countries using services micro credit companies in this time, because we're talking, of course, about 10 years ago, 9 years ago. This service was just started, this sector just started to work, and unfortunately, that regulation of anti-money laundering was not so strong, and for criminals was quite easy to get small amount of money. And of course, if just we never discuss it about microcredit company as serious issue or serious threat for terrorist financing before this story, because it usually was these crimes against this company were related maybe with fraud, but after this event. Yes, and sorry, just for I was a little bit interrupted. That now what we have from this story, we see that first of all, here criminals received quite small amount of money, because usual for a microcredit company we're talking about 3,000–5,000 euros maximum. But in this situation, for terrorism attack was enough to get these assets to buy ammunition, and as we say, ticket. Brussels, Paris, and for criminals go to Paris from Brussels and conduct this terrorism attack. As you see, as you could imagine, it was not very expensive, talking about budget, but result was very, very terrible. I mean, here, if I'm correct, during the attack in Paris, most 100 people died. Fortunately for law enforcement, fortunately for us, these criminals who committed this attack, they were identified, they were arrested, and they were convicted. At least main persons. But after that, it's a very good one of the example when absolutely, actually, one is service of microcredits, which never work with big money, serious assets. How these assets was possible to get, quite easy to get, without proper customer due diligence, without proper identification of customer, and was possible to use. In many countries, after these attacks, microcredit companies started to be very serious object of monitoring. And I also remember from my own experience that in Lithuania, this sector was after this, sorry, not after, but just before already this attack was under very serious control, because we identified first of all a lot of fraud attacks, not terror, but fraud attacks against this sector, especially using, or better say, abusing personal data of different citizens, when criminals using the personal data received from other person in criminal way, receive these assets, receive this credit, but you know, the other side of this business or industry, huge interests, which clients must pay. And of course, people, I could say here, were victim 2 times. First time when somebody using this personal data receive this credit, and second time when they receive a message from court, from marshals, that from bailiffs, that you need to pay back to this company, not only money which you never receive, but also high interest. And now, after additional measures, after very hard measures of supervision, this industry, of course, is more and more transparent. But what happened in Paris in 2015 and Brussels in 2016, many victims of attacks, and unfortunately, by this life, we never could get back.
Thank you very much, Iris, for that, for the explanation of the scheme. Yes, unfortunately, the terrorist attacks succeeded for the terrorist groups, but now we understand the origins and adjusted the systems accordingly here in the European Union, and monitor the microcredit companies more closely. All right, when we narrow our focus to East Africa, the picture becomes clearer and more complex. The region has become one of the most dynamic environments for terrorist financing, shaped by a mix of cross-border trade, cash-based economies, and expanding financial technology. What you see on this slide are the main networks and typologies driving activity across 5 key countries. In Somalia and Kenya, Al-Shabaab remains the most sophisticated financier in the region. The group's funding model combines extortion, local taxation, and control of trade routes. It operates at both militant organization and a pseudo-government collecting revenue from businesses, checkpoints, and informal remittance channels that cross into Kenya. In Mozambique and the Democratic Republic of Congo, Islamic State affiliates have turned natural resources, particularly gold, timber, and precious stones, into sources of income. They exploit weak border controls and unstable mining regions to extract, trade, and smuggle goods through neighboring states, converting them into cash or digital assets. Also in Kenya and Tanzania, smaller domestic cells continue to rely on remittances and small cash transfers. These flows are often legitimate in origin, family support, or business payouts, but are diverted through informal networks or cash-based businesses, making them almost invisible to traditional monitoring systems. Uganda and Sudan, meanwhile, act as transit and logistic hubs, supporting regional terrorist financing movements. Uganda has seen recruitment and funding for the allied democratic forces via mobile money platforms, while Sudan's porous borders and cash economy make it an attractive corridor for laundering and transit. Across these cases, the same pattern emerges. Terrorist groups adapt faster than regulatory systems. They exploit the gaps between jurisdictions, between formal and informal systems, and between technology and supervision. And for East Africa, the way forward lies in coordination. Cross-agency data sharing, harmonized supervision, and joint training across borders are no longer optional. They are essential. And the region's response must match the agility of the threat. By investing in capacity, technology, and professional competence, East Africa can move from being a high-risk region to a model for regional resilience in the fight against terrorist financing. All right, thank you very much. This was everything for this presentation. And now we'll have a panel discussion. The issues we've just explored, from evolving terrorist financing typologies to regional coordination gaps, highlight one clear message: no single institution can address these challenges alone. That's exactly what this panel is about: how we can breach those gaps through stronger supervision, better cooperation, and sustained capacity building. Please join me in welcoming our distinguished panelists as we continue the conversation on how to turn these challenges into practical, coordinated solution for the East African region. And the first topic of our panel discussion is from evaluation to action, aligning Kenya's priorities with practical reform. As we have heard, Kenya has done significant achievements already in terms of the legal frameworks, in terms of things that work in practice as well. But what do you think? Let me ask our panelists, what do you think are the next steps? What has been done, and looking forward, what are the next steps for Kenya's compliance? And I would then gladly also ask Igris about his vision on what should be done and what can be done. All right. Who of our panelists would like to speak first?
I think I can go. Yeah.
All right.
Yeah. So some of the things that should be done is aligning Kenya's priority with the Financial Action Task Force evaluation findings that were highlighted earlier on. And this will include collaborative effort between regulators. So they must provide clear guidance and oversight to the various reporting institutions. So the Financial Reporting Center should, or of course it already is, but it should enhance financial intelligence by improving the use and quality of financial intelligence products. As for the central bank, they should strengthen the risk-based supervision of financial institutions and coordinate with the emerging virtual asset regulator, which is both the CMA, the Capital Markets Authority, and the central bank. For banks and financial institutions, they must enhance their due diligence process. So improving their customer due diligence by implementing stricter due diligence on high-risk customers and politically exposed persons, as well as enhancing suspicious transaction reporting. So increasing the quality and volume of STRs, suspicion transaction reports filed with the Financial Reporting Center. For lawyers and the NFBs, we must embrace the new role as reporting entities. So, collaboration with the Law Society of Kenya to develop guidelines and implement internal compliance mechanisms for reporting suspicious activities for lawyers, as well as raising awareness within the legal profession by conducting awareness and training, which I believe we are doing in collaboration with the AML Certification Centre on the 30th of October to the 1st November, whereby we'll host a workshop on anti-money laundering and terrorism financing, and participants will be issued with the globally recognized CPDs. So yeah, that's just an overview of to answer your question. Thank you.
Thank you very much, Robert, for sharing your vision. Eric, would you like to add something in addition?
Yes. Sorry, I realized my network was my microphone was off. So I think that the greatest challenge we face, if you review the FATF findings with regards to Kenya, is the lack of evidence that we are evaluating the risk and taking appropriate action on the reports that are being sent to the Financial Reporting Center. So I think that one of the greater efforts that the country must make is in the fight against corruption, demonstrated fight against corruption led through intelligence and forensic evidence, because that has been one of the greatest challenges that we have faced as a country. The other one is with, and just adding what Robert has said, is that when you look at the targeted transactions that are susceptible to AML regulation in law, in the country we still have sell and transfer of property being managed or can be done not just by advocates or estate agents, but can also be done by the individuals or the landowners. And I think that one of the issues that was highlighted as the society was, the Law Society was being declared an SRB or a self-regulating body, is that there is a need to tighten that area so that because the effect of it is that if you are requiring advocates to give to make suspicious transaction reports, and the areas under which they report is, for example, sale and transfer of properties or purchase of companies, and those can be done by individuals. It basically means that those who would want to evade the anti-money laundering requirements would then do it in person. So there is a need to change the law so that then this can only be done by advocates, and so that you tighten that space to ensure that such transactions, which are highly susceptible to AML, are not conducted by any other person other than regulated professions, so that the enforcement mechanism can be much more stricter, because unless we can be able to demonstrate that one, the Law Society of Kenya as an SRB is conducting and carrying out its mandate through a risk evaluation, but also the reports that are then coming out from it. What are they showing? Are they in terms of, if you look at the FATF recommendations and some of the challenges that have been highlighted, you see that the sell and transfer of properties is one of the areas that is highlighted as a very weak area. And so I think that it is important for those actions to be taken, even as we work and strengthen the collaboration between the FRC, the Ethics and Anti-Corruption Commission, the Office of the Director of Public Prosecutions, to get us some convictions that can demonstrate to the whole world that we are taking the fight, the AML CFT fight, a little bit much more seriously. So that's all, Andre, from my end. Thank you.
All right, thank you very much, Eric, for sharing your vision on what must be done. Unfortunately, Igoris has a plane right now, and he should have left us a bit sooner. But don't worry, he will be joining us in Naivasha for the whole time of the training. And also, the thing I wanted to add on his behalf from what we have discussed with him, which is one of the, if not the most challenging issue, not only for Kenya, but I believe for every country which is in the FATF gray list, is the regulation of the NPO sector or recommendation 8. So what FATF requires, countries must identify which NPOs are most at risk of terrorist financing misuse and apply measures proportionate to that risk, not blanket regulation. And the next steps is, of course, undertaking a national non-profit organizations sector risk assessment, jointly led by FRC, NGO coordination board, etc., and classify NPOs into risk tiers based on activities, funding sources, geographic reach, their geographic activities, whether they operate with some conflict zones, and etc., and use results to prioritize supervision, outreach, and resource allocation as well. And why it matters, FATF expects countries to demonstrate that it understands that the countries understand its NPO landscape, not over-regulated. This is, I believe, what he would have added in this case. All right, as we move forward to the next topic of our panel discussion, let me ask our panelists one of the key questions regarding the interagency cooperation, which Eric has already touched upon, but let's dive a bit deeper. And let me ask you the first question. Kenya's FATF evaluation and the current gray listing discussions have shown that interagency coordination is crucial. What practical steps can be taken to improve information sharing between the Financial Reporting Center, law enforcement, regulators, and the private sector? What do you think? Who'd like to start?
I believe I can take that question. So interagency cooperation is very important, especially in this context of AML CFT compliance. So the financial oversight bodies in Kenya must develop stronger links between the Financial Reporting Center, the Central Bank of Kenya, the Capital Markets Authority, the Law Society of Kenya, as well as law enforcement agencies. And this can be done through formalized agreements, joint operations, and enhancing data sharing protocols. Yeah. So essentially, I'm advocating for the building of stronger links between the relevant financial services regulators and professional regulators, and for interagency collaboration. So this should be done by one, formalization through collaborations and MOUs. So official MOUs should be signed outlining the roles, responsibilities, and protocols for information sharing, for example, among the various agencies that I've mentioned. I believe also joint task force should be established, whether permanent or ad hoc, to tackle complex financial crimes involving multiple jurisdictions or sectors. I think you gave a wonderful example of emerging areas such as virtual assets, whereby you are seeing terrorist organizations using them to conduct their terror activities. So this will ensure a cohesive response to threats that span through the various agencies' purviews. Also conducting joint operations, and this can be joint inspections, raids, and investigations to essentially pool resources and expertise, increasing the effectiveness of enforcement actions. Organizing interagency training is another key element. So development and implementing joint programs to foster a common understanding of financial crimes, sharing best practices, as well as improving operational coordination during real-world scenarios. Some practical steps for risk-based supervisions are one, identifying and prioritizing risks. This can be done via using data analytics and financial intelligence to identify and prioritize the most significant threats, allowing regulators to focus their resources on the highest risk sectors, institutions, as well as individuals. Another key practical step for effective risk-based supervision is enhancing data analytics capabilities. So investing in the latest technologies, such as AI, to analyze large data sets from suspicious transactions and other sources will enable early detection and anomalies and emerging threats. And adopting a dynamic supervision model. So the regulator should move away from the rigid rule-based approach to a more flexible model that adapts to new and evolving risks, such as cyber threats and fintech disruptions. And of course, continuous training. Thank you for that.
Thank you very much, Robert. Eric, would you like to share something, or I will share my thoughts and Igor's thoughts also with the audience? All right, I will just quickly add something to the Robert's speech, because his speech was quite extensive regarding the practical steps what should be done. But as was mentioned by Robert, joint stand-up a JML MLIT style public-private partnerships, which are currently being developed here in the European Union, which is greatly emphasized by the new anti-money laundering authority and other international European regulators, is, for example, a monthly forum chaired by the Financial Reporting Centre with the Central Bank of Kenya, Capital Markets Authority, Insurance Regulatory Authority, and other regulators, and 15-20 major reporters, banks, MNOs, PSPs, virtual asset service providers in the future. And the agenda could be about current threats, priority typologies, and time-bound taskings. Why these public-private partnerships and forums are important for interagency collaboration is that because people form personal connections, which is especially important during investigations, because an investigator investigating a money laundering case or a terrorist financing case without personal connections, should file a formal request to ask for some data. If they form personal connections, they have easier access to data, easier access to the person to ask them about some sort of information, and also synchronize the current risk landscape in the country. And that's what also we're trying to achieve during our Naivasha event. We'll be hosting a closed regulatory roundtable. Could you write in the chat whether there are some representatives from the public sector, from the regulators, and whether you're going to the closed door regulatory roundtable? It is a closed event, but hosted to regulators, made as that type of forum to start this conversation and collaboration. Yes, and this is like one of the quick wins which could be done. All right. Also, we have discussed about the regional risks, that risks come from other countries and the financial systems are interconnected. Let me ask our panelists, could regional initiatives such as joint investigations, shared databases, or secondments between agencies be realistic in East Africa and in Kenya? And what lessons we can learn from the European model, which I shared previously, such as the creation of AMLA or other region-wide supervisory colleges. All right. All right, Eric, I see that Eric has left us unexpectedly, but Robert, maybe you have some ideas on whether these joint investigations and shared databases and the creation of some sort of regional cooperative body so that different financial reporting centers from Mozambique, from Tanzania and Kenya come together and share data regarding their is it possible? What do you think?
Yeah, it's possible and it's actually happening. There's the Eastern and Southern Africa Anti-Money Laundering Group that is a working group for the Financial Action Task Force that includes countries from both Eastern Africa and Southern Africa. I think it's over 22 countries that come together, the financial reporting agencies and the AML, let me call them community, to check on the AML standards of the region. And regional cooperation is important, as you know, the financial flows are cross-border. So, there'll be a lot of information sharing in terms of best practices in various jurisdictions. I think you've highlighted Mozambique as well as two other countries that managed to get out of the gray list, so they could offer, valuable lessons to countries like Kenya and others that are in the gray list to help them get out. Like you said, some of them are even viewed as national obligations, right? So they even amount to acts of patriotism, So for me, I believe it's quite important, the interagency cooperation between various jurisdictions, because of those reasons I've highlighted. Yeah, and of course, the need for a regional training hub is quite important, as we expect the economies in the region to grow. So also there's a high risk of illicit financial inflows in the region as the economies grow. So there's that danger as well. So training for compliance officers in various organizations on AML CFT obligations is quite important. Yeah.
Thank you very much, Robert. I see that we are really we're really close to the finish of this session. So I would better switch to the Q&A session and ask our audience to ask some questions if they have some regarding the topics we covered. If not, we'll close this session for today. See you in Naivasha on 30th of October. We together, all the panelists and more experts from the Baltic states and Europe, from leading European banks, will be joining there us as well to share their practical experience. And also check your email after this session. You'll also receive a small present there. And tomorrow you will receive the certificates of attendance to the emails you indicated during the registration. And let me answer some questions we already have here in the chat. The first question was, is anyone there? All right. Yeah, everybody is here. We answered this question. Let's come to another question. Hi, a question from Kate. Hi, Kate. How can I attend the Naivasha conference? Well, one of my team members already shared the link in the chat. It is events.amlcertification.com, and you can also scan that QR code you see on the left corner. You can check the event. It's 3 days event, by the way, in Enashipai Spa and Resort, and just you're welcome here, everybody. Hi, everyone. Is there a recording for the session? Yes, there will be a recording for the session. You will also receive the link to this recording, so you can come back and listen to me, to Igris, to Robert, or to Eric or Barbara again. All right, any more questions? Will the event be also virtual? Can one register for the same? Unfortunately, there won't be a virtual event. It is only physical. To keep the main idea of this event is to connect with each other and with the regulators as well. Yeah, so answering this question, there won't be a virtual event. So it is important to visit it physically. We still have some tickets left, so you can ask for the invoice, and our team will come back to you. Denver, thanks for the informative session. Truly thought-provoking and relevant. Thank you very much. The sessions will be even more thought-provoking and relevant during our physical events in Naivasha, in Enashipai Resort. All right, any more questions? The questions about the FATF gray list or terrorist financing typologies. Oh yeah, I also see one question from Joel. What are the thresholds that European banks have for movement of money that have to go through AML? All right, so basically in Europe, we have different thresholds for, especially for cash and for money transfers, and recently also for crypto asset service, crypto transactions. And for crypto transactions, it's 10,000 euros. Oh, sorry. What am I talking about? It's the travel rule requirements for unhosted wallets, which are the wallets that are not on the centralized exchange, which are the wallets like Trezor physical wallets where you keep your crypto assets. These must be verified always according to the transfer funds regulation. And we also have a unified threshold for money movements, which is 10,000 euros, which is in accordance with the FATF recommendation and the FATF guideline of $10,000, which is more international. All right, any more questions? All right, if there is no more questions, I would happily close this session. Thank you everybody for joining. Thank you everybody also for answering my question during the terrorist financing part. I see there are some really brilliant answers which indicate that you understand this topic, which is really cool. Thank you very much for this, and see you in Naivasha.